What is going on, traders? Packed show for you today. Here is why the banking mess isn't over. We're going to be discussing the credit crunch as it worsens. Bankruptcies are climbing. We are seeing the highest number of bankruptcies in at least 4 years, even more than the 2020 pandemic, especially in private small companies. We're going to be discussing the recessionary picture as it becomes clearer this week with the top companies reporting earnings. The top companies in the US stock market are all reporting this week, minus Apple, Microsoft, Alphabet, Meta, Amazon, and then some of the semis such as Intel, but also the major oil corporations such as ExxonMobil and Chevron. The bond market is signaling complete uncertainty with almost every single yield lopsided and just flip-flopping all over the place. We're going to get into that. Tesla, is this a sign of things to come? Tesla, also one of the biggest companies in the stock market. Tesla reported earnings last week, but more importantly, on the call, Elon Musk said that they are willing to take a loss on the cars because in his mind, they want to capture as much market share as possible, and that way they can monetize these customers later on. However, he wouldn't be taking this measure if he didn't think that sales might slow down because of what's to come. So are they a canary in the coal mine? Market breadth looking super weak, especially as it relates to the top tech stocks. We will take a look at the charts. And the S&P has now been in a tight 9% range for almost a year. So this hypothetical sideways market that everybody was projecting actually has been playing out. So we will get into the chart, look over what the S&P support and resistance levels look like. This is the longest range of sideways trading after a bear market. Are we going to get a 1981 looking scenario where we were reeling from double-digit inflation, but the market made a top as soon as it looked like inflation was actually on the downtrend? And as the Fed started to raise rates, the market actually made a top, and everyone thought that the bull market would continue from there on. But as you could see here, the Fed funds rate took an absolute beating on the economy. The GDP in 1981 was 2.5%, but because they kept rates higher for longer in order to combat this double-digit inflation, the Fed funds rate, keeping the rate higher for longer, had a devastating effect on GDP. We fell into a negative 1.8% GDP in 1982. And in the 80s, when we were finally thrown into a recession because the Fed funds rate completely devastated the GDP, the market actually matched the bottom that we saw in 1980. It matched it in 1982 before taking off into a historic bull run. So we will get into all of this in the video. Everything will be in the chapters below. Let's get started. But one thing before we get started, we are doing a free Mastermind Zoom. This is usually only for the Traveling Trader Academy members. We're opening one up to the public so that you can get a glimpse of what is covered in these masterminds. This will be absolutely free. You definitely want to join. Click the link in the description, answer the questionnaire. If you are approved, you will get an email saying that you are approved and that you have reserved a seat to the mastermind. The last mastermind, these are the covers. These are the topics that we covered. It is very trading and technical analysis focused. Again, this is absolutely free. So click the link in the description, answer the questionnaire, and you will know immediately if you are approved or not. Let's get started. So the credit crunch worsens as bankruptcies climb. As I said before, this could be the final nail in the coffin. This, along with earnings, could be the final nail in the coffin that will push us into a recession, because if the banks are not lending out money, then spending drops. You see businesses going bankrupt, which we'll talk about in a second, especially small businesses going bankrupt as they cannot access capital anymore because banks are stingy at the moment. And why are they stingy? Well, for a few reasons. One, because of fear, right? As interest rates climb, they're afraid that businesses and consumers alike won't be able to pay back the large interest payments on the money that they take out or the money that they borrow, but also because deposits are declining. And what happens when deposits decline? Well, banks lose the ability to make money because now in order for them to attract depositors, they're going to have to raise yields on their savings accounts. And you guys might have gotten emails from your different institutions saying, hey, actually, we're offering a 4% or a 5% yield if you deposit your money with us. So the banks are having to pay a lot more to depositors in order to keep them in the bank. That obviously hurts their profitability. Also, if you take a look at this, this is the stingiest standards that we've seen since 2008. Credit cards, loans to small businesses, loans to large and middle market companies, and commercial real estate are all at levels that we've seen briefly in the pandemic, but they're all levels that we've seen akin to 2008, where banks are really holding the money, the capital that they initially were going to loan out to the public. They're just holding it close to their chest. Now, this is leading to the largest number of bankruptcies that we've seen in at least 4 years, even more than the pandemic, where the pandemic just completely had a devastating effect on small companies. Now we are seeing it not because businesses are shut down due to a pandemic, but because banks are not giving funding to these businesses, and these businesses have nowhere to turn. We are now seeing the US default rate, which is here in blue, now climbing once again. And if it surpasses the junk spread, which is in the black line, you can see that that signals a recession each and every time, something that we saw really since the dot-com crash back here. Now, as I said, we have the biggest companies reporting earnings this week as of the time of this recording. This will, in my view, just as Tesla was probably the precursor, what Microsoft, Alphabet, Meta, Amazon, etc., is Intel, what they say in their earnings guidance will really give us a clearer picture of whether we are now in a recessionary environment or not. We know that they are laying people off like crazy. We know that Microsoft has completely vacated one of their headquarters up in Washington. The companies might report decent earnings, but the outlook on whether there's going to be any growth or whether they will likely cut into margins in the same way that Tesla mentioned, that is yet to be seen. And I think this week will be a lot clearer once we get earnings reported by the top echelon of the US stock market. Now, Apple reports next week as of the time of this recording, and I do see that Apple is in this huge descending channel here, hitting the resistance of this descending channel, a level that it has respected for a year and a half, since December 2021. So I'm looking at a potential bear vertical spread. I will be sending that trade out in the Academy. And if you do want that trade specifically, as well as some of the other earnings trades and the 2-year futures trade that we already put on, which we are up about $150 per contract, link is in the description. Come join the Academy. Obviously, you have to apply. And just like the free Mastermind Zoom call, if you are approved, you will know immediately. But that link is also in the description. Bond market signaling complete uncertainty. If we take a look at the bond yields, they are now all over the place. The 1 month is paying 3.5, but the 2 month is paying still almost 5%. So that is a huge disparity there. The 3 month paying a little over 5. And then once we start getting into the 1 year and above, it starts dropping sharply into the 4s. But then the 3 year and up is paying in the 3s. So almost every single bond yield is inverted at this point. But even on the short leg of the yield spread, right, you tend to see some sort of similarity between the 1 month, 2 month, 3 month. But now these are starting to diverge away from each other. This signals complete uncertainty in the short-term outlook of the market and the short-term outlook of the economy. I do have a bond ladder on. I will likely switch off of the bond ladder into maybe just investing in the 3 month and 4 month treasuries now, as the 1 month is no longer offering an attractive yield for me at 3.33%. Why would I do that when I can get 5 at 2 month and 3 month? And I will be going over a bond ladder and how to buy bonds on TD Ameritrade in the Mastermind Zoom call, because it is one of the things that you guys have requested, one of the most things that you guys have requested. So I will be going over that. Again, that call is totally free. Click the link in the description. Tesla, a sign of things to come. We kind of covered this already, but Elon Musk said they are willing to bet Tesla's profits on a driverless dream. So they're taking the Apple approach, where Apple wants to get as many devices in people's hands as possible, and they want you to buy into the ecosystem. So if you buy the iPhone, for instance, you are more likely to buy, the AirPods and the Apple Watch and an Apple computer, etc. But you are bought into the ecosystem because all of these products play with each other. So Elon is looking to get as many Teslas in as many drivers' hands as possible, and then hoping to sell them on future features such as full self-driving, robo-taxi, Tesla insurance, etc. So the car itself is going to be sort of a moneymaker where they can maximize the revenue per user. This is actually very smart, because cars are obviously one of the products that take a huge hit when the recession is coming. So I think, Elon is not stupid, and I think he sees the writing on the wall, and that's why they keep dropping the price of the cars, and they have dipped under that 20% profit margin that Elon has not really promised, but has, communicated that they want to stay above. And now they are under that 20% profit margin. And he's happy to, bet the entire profit margin as long as people keep buying Teslas and take advantage of the price drops. But would Tesla be doing this if they thought that the economy was healthy? No. So that is why Tesla might be a canary in the coal mine as it relates to mega cap companies. Now let's talk about the market breadth, and then I will get into the chart. So if we take a look at this chart, this is basically a divergence between the AD line, the 10-day AD line of the S&P 500, the advanced decline line, and the S&P technology stocks, right? And if we take a look at the divergence between the price of the S&P technology stocks and that 10-day S&P AD line, which is market breadth, basically, you could see that we are now at the highest divergence level since 2011, which was a bear market that really slid under the radar, and 2008, which needs no explanation or introduction. And this is very interesting, showing its head during the week of the mega cap tech earning stocks. Again, everything besides Apple reporting this week: Microsoft, Alphabet, Meta, and Amazon. So if we take a look at the S&P chart, as I said, we've been trading in this 9% range, these two green lines here, really for a year now, since May 2022. And I think that this has kind of gone over people's heads because everyone was measuring this trend line here, and we broke out of it, right? And the bulls celebrated, but then when we fell back below it, the bears celebrated. But if we remove this trend line here, and this is what I said on Benzinga this morning, by the way, shout out to Benzinga for having me on their live show. You could see that aside from a couple of outliers, the 3,800 to 4,200 range has been the range on the S&P 500 for a year, since May 2022. And I think that if we get a negative earnings outlook that clearly shows a recession is on the horizon, I think we will reject here and get back to at least the 3,800 level. Now, whether we make new lows or not, I think will depend on a few things. Will we see a credit event from the Fed interest rate hikes, which we are going to get for sure almost now, a 25 basis point rate hike at 91% probability in May. And in June, it looks like there is a 68% probability that the Fed is actually going to pause. So if they actually hike and then pause and keep the rates up there until we see potentially more defaults especially in the small business sector, until we see commercial real estate potentially defaulting, until we see another issue with the banks popping up, there will be something that cracks that is not obvious to the naked eye. Depending on the extent of that, we could make new lows. I'm not a fortune teller. I don't know what that black swan event could be. But this is very interesting if we take a look at 1981, because in 1981, we saw a very a very similar phenomenon. In 1981, we were reeling from double-digit inflation, right? If we take a look at this is one of my favorite articles discussing GDP, Fed funds rate, as well as inflation. But the inflation rate in 1980 was 13.5%. Crazy. And this is when Volcker decided to pump the Fed funds rate up to 20%. Now, if we take a look at March 1980, you could see that that was shocking to the market, taking it back to the recent lows. However, after that was digested and the Fed, that crazy 20% Fed funds rate was instituted, the market digested that and actually made a new high. It made an all-time high here in December of 1980, as you can see here. But what happened? They kept the Fed funds rate higher for longer, all throughout 1980, all throughout 1981, and we finally got a recession by May 1981. So if you take a look at May 1981, you could see that is when the market was consolidating sideways, as we see now. But then once the full effects of the recession hit, and we got to, in 1982, negative GDP, because the Fed funds rate was higher for longer in order to combat this double-digit inflation, which was 10.3% in 1981, dropped to 6.2% in 1982, and finally 3.2% in 1983. you could see that the market actually matched the lows that we saw in 1980 under the pressure of the Fed funds rate. So that is why this sideways trading here, I don't think is going to last for the rest of this year. I think at some point this year, we will get a make it or break it answer as to whether the Fed is going to break something and the GDP ends up because of the credit crunch, as well as something that might possibly break. If we will actually crack this and reach the lows that we saw back in October, or potentially go below. It really depends on the extent. Now, if earnings don't disappoint, and if the mega cap tech companies are like, "Hey guys, yeah, we laid a few people off, but everything looks good," then we might get to the 4,300 resistance outlier that we saw in August 2022. Now, for me, I will be a buyer if we reach the 3,800 level once again. I'm not saying that that's the bottom, but for me, that is a good price for the long term, and I will continue to buy from 3,800 below in order to build a long-term position at a much discounted rate. Anyway, traders, that is it for this video. Again, we are doing a free mastermind. You definitely want to join. Link is in the description below. Absolutely free. Don't be an ass. If you do click it and you do get accepted, make sure that you join the call. Don't just take up a seat. It will be recorded. It will be sent out to those people who actually are approved, who click the link and who are approved. So make sure you do that. And the recording will be sent to you. Again, absolutely free. Let me know in the comment section below. Do you think that the S&P 500 is going to reject from this 4,200 level here? Do you think that earnings are going to come in, decent, and we do see S&P 500 go to at least 4,300? Are you buying stocks at the moment? What are you buying at the moment? Do you think a recession is underway in 2023? Do you think it's going to get much worse, or we're going to have a shallow recession? I really want to hear from all of you guys. Leave it in the comment section below. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.